So we're going live. Ignore the computer. I am the one you're talking to. So after you hear the sound, that whole thing.
Will we hear it?
Yeah, you hear it roughly.
Okay.
But I have to play it low because it will feed back into your mic.
Understood.
But you will do the countdown, isn't it?
Yeah.
So.
Hello there, welcome.
Just live. We're just doing what is that thing called, Kimberly?
Like a holding slide.
We'll be live shortly. Splash.
Understood. We'll be live shortly. Splash screen. It's even called Splash. Hello there, welcome to the NCBA.
So after we go live, we're going live and then we go No, they had accelerating what I'm saying.
Hello there and welcome to the NCBA Money Mastery Series Season 4, where we teach you how to make your money work for you. My name is Daniel Makau and I'm excited about numbers because here at NCBA, the numbers that matter to you matter to us. So here are some numbers that matter as you consider your investment options. 10 billion. This is the estimated amount of money that Kenyans have lost through get-rich-quick schemes in the year 2020 alone. 63, which is the number of listed entities in the Nairobi Securities Exchange. And 4 trillion shillings, the amount the government has borrowed from Kenyans. You've possibly come to that place in your life where you're thinking of how to secure your future. And you've probably realized that the amount you make every month probably will not guarantee you the life that you dream of. And perhaps you're wondering, what are my real and practical investment options? Well, my guest today is Mwenda K.Rarama, Senior Manager, NCBA's Investment Bank. Mwenda, welcome to Money Mastery.
Thank you for having me.
Well, Mwenda, as we start off, what is the biggest misconception that we have when it comes to investing?
The biggest misconception that we have is that you can actually get rich quick. Well, you have mentioned that more than 10 billion was lost in 2020 alone. It's an estimate. I believe over the years, Kenyans have lost a lot of money. It takes time to make money. You need to put in the time and the effort that is required and give whatever it is that you're investing in time to actually grow. But this get rich quick kind of situations have really led Kenyans to lose a lot of the capital that they have made over the years.
Well, that's noted, but we continue to see these schemes coming up every single day. I mean, how are they so successful at swaying people and convincing people to invest in them?
I think the thing, and if you listen to our previous episode, you'll actually notice one of the main things that we discussed was risk and how to profile yourself and know exactly what level of risk you can take. The reality is, and Samuel did speak about greed, the reality is that if you don't measure your risk properly and you don't know exactly what you're getting yourself into, then someone else will take advantage of you. If you're not the one sharing whatever is on the table, then whatever is on the table is what you bring to the table is actually what is being shared. So you've seen a lot of Kenyans not having the right information, not having the right measure of the risks that they can actually take at whatever level of their lives they are in. And the end result is they are driven by greed, they're driven by the want for money, and they end up being swindled a lot easier than what you'd find in most of the other countries that we actually are, where people are a lot more careful what they do with their money. I think Kenyans need to be a little more careful in measuring the kind of risk that they may end up in, and how exactly they are going to get the return that they're chasing, or rather the money that they're trying to make.
Okay, so I hear something there around measuring risk and looking at behavior, people trying to, to get this money quickly. So there's an element of time. There's an element of time there, and it's quite clear that wealth takes time to build. So how does one take advantage of their income to then build their investments?
We talk about wealth journey. Wealth has a journey to it. The idea behind wealth is that you're able to sit finally when time comes to sit home and have income coming in to pay your bills, to take care of you, without you having to put in the effort to actually look for more, making your money work for you. Now that is a journey. The earlier you start it, the better it is. Warren Buffett started off at the age of 17. Today he's made a lot of money out of what he invested, but he started very, very early. He started putting money aside and building and investing continuously over time. So you need to be consistent, but you also need to give it the time. So when the time comes and you actually need to move away from what you'd call your active life, then ideally your money, your wealth, or your capital is able to work for you and be able to sustain you during that period of time. So,
I like a statement you use there. You say it's a journey. And so we're talking, basically saying that, it's a long-term investment, isn't it?
yes, it is.
Yeah.
It's a long-term investment. You have to have the long view. Idea, if you have just started working or you're looking at starting to work, there's a way that you need to start learning how to handle money. If you're looking at someone who has been around for a while and is basically what you'd call a savvy investor, the way they look at things is very different from anybody else. We talk about the capital markets, and ideally it's a market for capital. So you need to raise capital, and capital is relative. It can be a shilling, it can be a million, it can be a billion. At the end of the day, once you have this capital, you go to the market and find a return from this capital. So you need to build capital, and capital takes time to build. It's not something you wake up one day and you're a multimillionaire, billionaire. That might be 10% of the people, but the rest of them actually take time to build the capital. And once you have the capital, then you need to go to the market and make sure you have return that is being delivered on this capital that you actually have.
Okay, you mentioned something there. You said if you're savvy, but you can guess my next question will be around what if I'm just not, investment savvy? I don't understand these terms. I don't understand how the market works. I don't understand this jargon. Where do I begin?
Ideally, the capital markets has room for the savvy investor who makes their own decisions, and also has room for the entrant who is basically trying to learn and has individuals or rather institutions that make decisions on your behalf. So the Capital Markets Authority has licensed institutions that ideally have expertise and experts in this. That is basically what we do as an investment bank. We are licensed by the Capital Markets Authority, and the idea behind it, and we have a lot of other players, is to ensure that you have expertise in being guided on this. You have someone making decisions on your behalf. So you can either go straight to the stock market. We have 63 listed institutions from all kinds of sectors, including technology, banking, manufacturing. So you make your pick if you're able to. But if you're not able to, then we have pooled funds that are licensed. There's what we call the equity fund, for example. The equity fund ideally does invest in shares, and primarily in shares. So if you're not a savvy investor who would go to that particular capital market, which is basically the Nairobi Securities Exchange, and be able to make your decisions and know what to buy and for how long to keep them and when to sell them and to buy them, you have experts who are making these decisions. So for as little as 5,000 shillings as starting capital, you can put money in a fund. They pool the money in a pooled fund, what we call unit trusts of different forms. And through some of them, which we call the equity funds, you're actually able to invest in shares without having the headache of trying to keep up with these particular institutions day and night. But someone else is doing that for you and ensuring that your money works for you and keeps growing continuously.
Okay, you've mentioned something very important there, is outsource the thing you don't understand to an expert. And I'd like to just double click. You mentioned equity funds. And I know there's people in the audience who are just starting their careers in their first job. They feel they're not making so much money. Maybe let's talk a bit more about the equity funds. What amounts are we talking about here?
Ideally, the starting off for most of them is 5,000, though I know that is also coming down. You'd have scenarios where even with 1,000 shillings, you're actually able to start off. And from there, whatever amount of money you get, whether you're running a business or you're in employment and you have a monthly coming in, whatever you get, just keep sending it there. Someone else is working to manage that money and grow it continuously. So as you send your money in, there's someone else doing the work for you. So you can actually concentrate on what matters. You can concentrate on making more money, whether it's from your employment or from your business. You have someone else ensuring that whatever capital you're putting aside, what we're calling savings, you have had the president saying Kenyans actually need to start saving. But the biggest challenge is not saving. Once you have saved, what do you do with your savings? Do you have someone managing these savings and looking at them for you? So even from a very young age, you can actually be able to build your capital continuously, ensure that it is safe. Because you have worked hard for this money. The worst thing about it is if you lose it, then it takes you back years and years that you have put in effort to actually build that capital. So once you have the capital, you've built a bit of it, and whatever way you're building it in small portions, let someone else ensure that that money works for you, and it's marketed accordingly, and it actually has a return accordingly, which is the expertise that, that the regulated entities actually offer you. That is the reason why the capital market is there. That's which as a regulator to ensure that your money is safe and well taken care of, and someone is supervising whoever is handling your money at the end of the day to make sure they do the right thing with your money.
Okay, that's interesting. So we talked equity funds, and you can start low, but what else is there?
What else is there? We spoke about the Kenyan government. Half of the debt, because we have had a lot of talk, we have just come from an election period, we have had a lot of talk about debt. Half of Kenya's debt is actually lending by Kenyans to government, through whatever institutions it is and through individually. So you have individuals, the savvy investors who actually visit the CBK, have their own accounts opened and lend to the government through the CBK, where ideally other people borrow for the government to ensure the government is able to move on and build infrastructure for their own budgetary support. If you're not there and don't know how to make the decisions of what to buy, how to buy it, then we have funds as well that are pooled. You call them fixed income funds, you may call them money market funds. I know that has had a lot of discussions on the same, and a lot of Kenyans have come to realize that actually that happens. And these individuals will sit back, look at the pooled fund, make investments, or rather lend to the government accordingly, and ensure that you're actually earning a consistent return from this. For as low as, again, 1,000, 5,000 shillings, you're able to start and put money aside and earns interest continuously. And when you finally do need the money, it's actually available for you to use. So there are products that ideally differ. So if you're looking at this Nairobi Securities Exchange, which ideally would be a riskier option for you because you're buying an institution, this institution might be able to pay you dividends, may not be able to pay dividends. During COVID, most of them didn't actually pay dividends. If you're looking for less riskier options, you now have what we call the debt market, where you are able to lend to the government securely, and you earn interest on a 6-month basis, or basically whatever period it is that the experts are making decisions on your behalf. So whichever way it works, it works perfectly.
Okay, interesting. I mean, you've said a couple of things. It takes time. This investment process takes time. There's get-rich-quick schemes don't always work. And very importantly, for somebody who's not so savvy, we've got experts out there that we can lean on to make the right decisions for us. And we've been talking about largely those at the entry level. You're just starting out, and perhaps as we just about to take a quick break, when we return, we'll be looking at investment options for somebody who's making a bit more money. They want to have some passive income, and they want to be sure of a consistent return. So for those of you listening in, please continue to share your questions. Mwenda and I will be sampling them after the break. So don't go too far away. We'll be right back after the break.
At NCBA, we can tailor-make your SME business solution to suit your business. It's what we have done for over 50,000 businesses so far.
50,000? Mommy, that is 50,000 families with 50,000 meals every day and 50,000 dreams coming to life.
We know that it's not about the business, but about caring for loved ones. Get NCBA SME Banking Solutions. The name is NCBA, and the numbers that matter to you matter to us. NCBA Bank. Go for it.
Well, welcome back to Money Mastery from the bank that says go for it. I've been speaking to Mwenda K.Rarama, our senior manager here at the NCBA Investment Bank. And Mwenda, we'd looked at, what are the opportunities for employed people with little left? But what about those with a little bit more? They want to look at, capital protection. They're looking at, they want to have a consistent fixed income somewhere else. How would you advise them?
Ideally, if you start investing early, then as you grow, you build your capital. So you get to a certain level where you actually have a capital base that can be managed on its own. Because if you bring 1,000 shillings, the best way to get the best return from it is to actually pull it with more money. So that you raise your 50 million, your 100 million, you're able to invest it. As you grow your capital and as you build it through these particular funds, then you get to a certain level where you actually are able to have this fund managed on its own. So as you get into your mid-working life, if you have been investing for long enough, you now have what we would call a portfolio that can be managed on its own. So you're going to a level where your capital now makes sense. You can actually go to an expert, have a discussion with an expert, and they tailor-make something specifically just for you. Even as you prepare to go into retirement, this is something that needs to be done so that whatever money you have, whatever capital you have built over the years, someone looks at it and tells you, this is the best way to invest it, this is how it will bring in the most income within a certain period of time, and it becomes a very easy and nice discussion to actually have. So my thinking is most Kenyans, when they have finally built enough reasonable capital, they have worked for a certain period of time, they are looking basically to prepare for their retirements, then you need to visit an expert. I'm assuming you probably may have been working with an expert all along. If you are not, then kindly do. Whatever stage you are in, where you are, visit an expert. Have a discussion with them. Let them look at your financial status. Let them look at what your needs are. Because at that midlife, you still have kids in school, you still have business to build, you still have a career to build. So you're still spending. But even as you spend, you have some money somewhere. Let that money start generating some income. The beauty is, as it's compounded interest on interest, as it's compounded return on return, income comes in, it adds income on income. By the time you're going 10, 15 years down the line, or 5 years down the line, whichever time period you're in and you're now looking to exit, then it changes the conversation all along, because the idea is when you finally leave, you still have a life to live. How do you live it, ideally?
Okay. I mean, this segment of people you talked about are perhaps those that are investing. We talked about 4 trillion shillings that the government has borrowed from Kenyans. And it's probably from this segment of people, we're looking at bonds, we're looking at bills. Perhaps maybe talk a little bit more about how that works.
Ideally, the government borrows from Kenyans through 2 instruments. One of them is a short-term instrument, so ideally 1 year and below. That is what we call treasury bills. So ideally, it would be 3 months, 6 months, and 1 year. Then it also has what we call the longer-term side of it. So from 2 years all the way to 25 years. And in that segment, we have what we call treasury bonds, which ideally are taxable. But they also borrow directly for infrastructure. When they borrow for infrastructure, this particular income that you earn on infrastructure bonds, as they are called, is actually interest-free. So you have, if you sit with someone, they're actually able to structure for you in a way that if you do need money, you know where to get it. If you can go long term, you know where to get it. So they structure something specifically for you. But the government is always in the market every single month borrowing from Kenyans. As you save your money, then ideally what you'll be looking at to ensure that your money is safe is to lend the government. You get reasonable returns over a certain period of time, and will ensure that your capital is still growing continuously. Even as you grow older, you're building the capital base that will actually be you rely on when you finally get there. You'll have built the wealth to sustain you even into your future.
Excellent. So far we've talked through people in different stages. Early stage, you're just getting out into the job market or just starting a business, and we've talked about those sort of in the middle there where now they've got a bit more to spare and they want to invest and have some passive income going. What about somebody 45, 50, and you're now thinking about retirement? What would you say to somebody in that phase?
Ideally, we would call them the people who are getting into the pension phase. So we know of pensioners, we have heard of pensioners.
Yes.
So you have now come to the end of your business life, ideally. So you don't have the energy that you had when you were younger. Yeah. You need to spend less in terms of energy, have issues in terms of health and what have you. You have not grown a lot older, you're looking to, and even if you don't exit, some of the world has a way of exiting you. So you may not want to, but it forces you out. The question is, when you get out, what happens? You probably would not have the same salary you had. It's not coming every month anymore. So, but you still have the expenses. You still have insurance. If the institution was paying for your insurance, if you are an employee, it's not paying anymore. If the business was generating enough income, it's probably either you have sold it, if you did, or it's not generating the kind of income that it was generating, because you don't have the time and the energy to actually push harder, as hard as you were pushing when you had the energy. So the end result is, if you don't have a replacement of this income that was coming in, then you end up in a situation that, unfortunately, is most of what happens, where Kenyans become dependent on their children, which is very unfortunate, where you are getting sick and you don't have, hospital bills are not being paid, you don't have rent, you don't have food on your table. So the discussion that needs to be held at that time is, past your working age, are you able to finally take a break and let your wealth bring in income? If you are employed and you have pension, let's have a discussion about how that pension is managed. Because if you take it out and go and invest it, are you able to generate monthly income that makes you comfortable for the rest of the life that you're actually going to be around? Or are you going to have a scenario where within 2-3 years that money is gone, and now you can't put food on your table, you can't pay your insurance, so you're having health problems? So the idea is to ensure that finally, when that time comes, your wealth is well secured, is safe. Your capital that you have worked for about 25 or so years to build is actually safe. It's something that you're going to pass on to your children. You know there's an inheritance for them. But even as there's an inheritance for them, there's enough income to sustain your lifestyle. There's enough income to make sure your car is serviced and fueled. There's enough income to make sure you have a roof over your head. There's enough income to make sure you have food on your table for the time that you're going to be around. Then when you're finally gone, then this capital that you built over the years can be inherited by your children. And ideally, they would continue building wealth, because wealth is generational. So when you pass, whatever you pass to them, if you have taught them and trained them well, so bring your kids to us. Let's have these discussions. Let's guide them. Let the discussions actually start very early, so they know that even as you pass whatever you have to them, they know how to handle money. I think the biggest problem with African society is that most of us learn how to handle money a lot later in life, after you've made a lot of mistakes. So the earlier you start, the better it is. And even as you progress, then when you have built your wealth, the idea behind money is to make you comfortable. So make money, let it generate income, because cash is king. Anything that you're paying, you'll pay in cash. If whatever you have in assets is not been generating cash to sustain you, you're going to definitely not be able to sustain your lifestyle.
That's a powerful statement you make there. It's okay to have land. It's a nice asset to have. But very importantly is you must have some kind of cash flow. Cash is important because you need to pay those bills. You need to keep, everyday life going. And maybe just changing perspectives a little bit. We've talked about the fact that it's important to find an expert to help you along the journey. But sometimes, as is typical, we want to do it ourselves. So what are some of the mistakes that you've seen that we make when investing, and especially in listed entities?
I think the biggest mistake that Kenyans are making, not just for listed entities, but most of the investments that they make, is they actually don't speak to the experts. When it comes to money matters, and this, it's always very close to the heart for everybody. Your money is very close to your heart. Speak to someone who actually knows what is expected of you. Your neighbor may be making money in one way or the other, but they may not tell you everything. Your friends may be making money in one way or the other. They may not tell you everything. Some of them actually take advantage of you and take that opportunity to make money from you. So visit an expert, have your own personal discussion with your expert about your financial status. So they tell you everything that needs to be done. And the beauty with regulated entities, and ideally what the capital markets provides, is to ensure that whoever you're speaking to has some rules that they abide by. Because your neighbor does not have any rules about how they handle your money or whatever financial advice they give you. But this person is obliged to give you a certain level of financial advice. And these entities, if you visit the Capital Markets Authority website, you'll find all these listed entities. And if there are any issues, you know you have a regulator to actually ask. So when I know I have restrictions, I'm a lot careful what I tell you. As an expert, there is expectation of what I'm supposed to tell you. But when the person who is advising you has no guidance whatsoever, has no rules, then when they take advantage of you, you actually have no recourse, and you really can't limit as to what you do. So I think the biggest problem you're having is Kenyans are getting financial advice, a lot of it, from places they shouldn't be getting it from. So visit the experts, have a discussion with them. They'll offer you the best advice that is best for you and just for you. Because this is very personal.
Yes.
It's not about your friends, it's not
Yes.
about your neighbors, it's not about what other people are doing. It's about what you are doing with your money.
Some powerful messages there. It takes time to build wealth. Start early because then you have the advantage of time. Seek an expert's advice so that you are securing that investment in the first place, and don't put it at risk of losing as you go along because of just the effort and the time it takes to. Thank you. I would like us now to shift gears a little bit. I can see the audiences are pushing through their questions, so let's take some time to respond to some of these questions. We've got a question from Joanne. Joanne is saying, recently started working. Can I use my little salary to invest in equities?
Ideally, yes. If you have just started working, it means you are young. If you invest, for example, I'll give you an example of the banking sector. Over the last 20 years or so, the banking sector has grown massively. With the number of Kenyans that are banked has grown massively. The kind of products that they are offering has also grown massively. I've seen massive growth over the last 20 years. So if you invested in this particular sector during that time, when it was just an asset and starting off, you have seen massive growth in terms of the kind of dividends they're able to pay, the kind of returns. Banks are making billions and billions of revenue. Ideally, they're offering these services to Kenyans. So the idea is, as a Kenyan, as you receive services, depending on who offers that service, then why not invest in these institutions that are offering the same service? As they grow and as you grow together, and you actually earn as they earn the same money. And that is the essence of the Nairobi Securities Exchange, to provide you that option. So when you are young, you're able to put money away for 20 years and continuously add more and reinvest that income, because you're still able to earn. You're in your working age.
Yes.
You're still making more money. So whatever you put aside, whatever capital you have aside, you actually don't need to take away the income that is coming from it. It can continuously grow, and you're able to take a lot more risks. Some of these companies will outlive you, some will not, but at the end of the day, there's a very likely, a big percentage of the investments that you make will actually outlive you. So you'll actually see a lot of growth and make a lot of money out of these institutions. Because since you're young, you have the expertise, then you have the funds that you can actually invest in through the equity funds that we have in the market.
Excellent. So Joanne, I hope you got the answer. The answer is yes, you can use your little salary. Doesn't matter the amount, and you can start investing in equities. There's another question here from Hassan. He says, he asked the question, with a capital of 400,000, what investment can one have in mind so that you can invest the cash and still make a daily living from the same investment of 400,000?
Ideally, I would ask Hassan to just give us a visit. We have a discussion, because there's a lot that comes into it. The ability to take risk. There's your risk appetite as well that comes into it. There's how long you're going to be putting that money away, which is also dependent on your age. There's quite a bit that we look at to be able to tell you that this amount is able to give you a certain level of return. So visit an expert, wherever it is that you're situated, have a sit down with them, have a discussion. They'll be able to guide you and gauge and tell you exactly what you can do and what kind of income you're able to generate from this. And if you're putting money away for a certain period of time, then remember it's growing. So whatever income that comes will actually be earning income on income, depending on what age you are. Do you need the income? Do you not need the income? So these are discussions that are very personalized, as I said. So my advice to you, visit someone, have a sit down, have a personalized discussion about your financial status. Because it's not just the 400. There's more that you may have somewhere, in whatever form it is, that actually can be grown in one way or the other.
Okay. There's an important point there around actually investing the time to come and look at the bigger picture before you make any decisions there. It's not just about, I have 500K, what can I do with it? There's a bigger conversation to be had there with an expert. So it's important for those who are listening, take the time, invest in actually coming to spend some time with an expert. Thank you for that. I've got a question here from Jeff. He's asking, how do I go about investing in bonds as an individual?
Jeff, there are two ways. Either you are able to invest on your own, so you visit the Central Bank of Kenya, you open what we call a CDS account, and you can be able to buy bonds any particular month when the government is issuing. The other option is to actually invest in a fund, in a pooled fund. through either an investment bank or fund manager. We have a couple of them, money market funds, fixed income funds. They all invest in bonds ideally. So you're able to invest, have someone make the decisions for you. Depending on what the amount is, then we can have a discussion of what exactly you can do. But there are two ways of doing it. If you're savvy and you know how to make the decisions of when to buy, when to sell, you go straight to the Central Bank of Kenya, you lend to the government through them because they're the people who actually borrow on behalf of the government of Kenya. If you're not savvy enough, then you visit someone, they pull the funds, they make the decisions on your behalf. At the end of the day, you can participate no matter what amount you're talking about, ideally.
Yeah. Okay, good. There's a question here from Richard. Richard says, the aspect of building generational wealth is what we critically need. How can one start to build generational wealth?
Wealth is also largely driven by the kind of information people have, the kind of education you have. We have education in all aspects. You become an expert because you have gone through training, 25 years to train the average Kenyan to finally hit the workplace. So we need also to train them on the financial matters, on how to handle money. It's a system. It works within a certain system, within an economic system that is very well designed and works in one way or the other. So in that case, you need to understand how it works. And even if you don't understand how it works, it's a journey. You start, what we do with our clients is every single client who we manage the funds for individually, we have quarterly meetings when we are managing that, and we discuss. We'll teach you about the economy. We'll teach you. We'll actually ensure that you get information, and you can bring your kids along. We'll teach them as well. Let them learn these things early enough. Yeah. So even as they do their schooling and become doctors, let them also know how to handle that salary that they're going to earn. When they become pilots and whatever else that you dream of them becoming, when the salary comes in, they need to know how to handle it. The younger they start, the better it is. And we are here to actually teach and train where there is need to ensure that this information is passed. Because as you grow your wealth, we also grow as institutions. So we want to make sure that you actually know how to handle money. Because if you know to handle money well, then it becomes a lot easier for everybody else, and life becomes a lot better. So bring your young ones along. Let's build the next generation, because you may have things that you may not be able to pass to them, but you'll be able to guide them accordingly and actually pass this information to the next generation, so that when you finally leave, they're capable of actually taking care of it. And they're not going to under it in day one.
Yes. Yeah. That's an interesting statement there. We must involve children from the get-go so that it becomes part of their culture, and not start talking about money when we can hardly see them even. And you know, they make the mistakes as they go along. So that's really important in terms of building generational wealth. There's a question from Juliet. Juliet is asking, is getting expert advice costly? It's a good question. And how much would I need to pay an expert for financial advice?
Ideally, the advice, I'll put it this way. Institutions don't charge you for advice, they charge you for the service. So when you pay me a visit and we are sitting and I'm guiding you on what I think you should do and listening to you and advising you, I'm not charging you a fee for that. But once you buy a product, then there's a fee for the product that you buy, which is ideally where we make money from. So we don't charge for financial experts. We ideally are licensed to offer guidance accordingly, and that is what we do. So we are not supposed to be charging for that. Of course, different players play in different ways and have different ways of looking at things. But ideally, if you visit our investment bank, we'll offer you advice. Whatever products you buy, whatever transactions you do, that is where the fee comes in. But before then, there's actually no fee for me having a sit down with you and having a discussion and guiding you on why I think you should go financially in terms of the decisions that you make.
Yeah. I think that's an important statement for not just for Juliet, but for everyone who's listening in. Come to the NCBA Investment Bank. The advice you'll be given is free. That's what we're supposed to do. That's how we would like to work with you and help you grow. Question here from Wihaki. She's asking, how easy is it to withdraw my money from an investment if I feel it's not going great? So I've put in the money, I've been convinced, but then along the way, perhaps something has changed, and I'm not so happy. How easy is it to withdraw?
Now, the beauty with pooled funds is that there's a portion that is provided to ensure that if any investor wants to get, or they're able to. So different funds will differ in terms of the time period, but they're actually supposed to be liquid. So for example, in our funds, you're able to get your money same day if you get as the instructions before 10 a.m. So if you are an NCBA account holder, the money will hit your account the same day. If it's a different bank, the money will hit your account the next day. So that level of liquidity to ensure that even as your money works for you, if you ever have a need, because this is your money, you actually should be able to actually access it and take your whatever need you are. Because you'll go out there, look for more money, bring it back. But the liquidity and access of your money is very important. And like someone who's investing on their own, they have to go figure out how to get a buyer for these assets and what have you, and it takes a bit of time for them to actually sell it. In a pooled fund or a fund where the money is actually put together, it's a lot easier because a portion is actually left out, purposely to ensure that there's liquidity to be able to pay you as and when you need your money.
Very good. There's a question from Edward here. Next question. He's asking, what is your opinion on Forex trading, and can we call it an investment option?
I'll put it this way. What I say about anything that takes money is if you know what you're doing in anything, because you can make money from anything, then there's a very likelihood you'll make money. If you don't, there's a very likelihood people will make money from you. So every one of these investments that we are discussing, whatever it is, they're actually complex in one way or the other, and you have to understand the complexity. So if you don't understand the complexity, then that's when you visit an expert. And the expert understands the complexities and is ideally charging your fee to make the decisions on your behalf. You're paying them something small to make those decisions. So if you know what it takes to do Forex trading, if you know what it takes to buy land, if you know what it takes to buy shares, if you know what it takes to buy bonds, and you know you can make those decisions, concrete decisions on your own, go ahead. If you don't, then visit an expert. Whatever it is you want to do with your money, it's always an issue of the knowledge gap. If you don't have a knowledge gap, you know what you're doing, then you can still make money out of it. But if you don't, then unfortunately, people will make money from you.
Okay, that's an interesting question, and it's a question that comes quite often. And I think you've answered it quite rightly. Seek the experts. They will help you invest in the right things. There's a very interesting question here from Okoth. Okoth is asking, how can I navigate black tax while saving at the same time? And you know black tax, because you've got siblings, you've got parents, you've got aunties and uncles. You're the one person that made it out of the village. You're the one earning money. Everyone expects you to sort out all. The question is, how do you navigate?
I'll put it, your income earning ability grows continuously if you're putting in, through your working age, if you put in the necessary effort to actually make money. As you grow, you'll make more. At the very beginning, you actually are not making a lot. So you need to be very careful to make sure you pay yourself first. Before you send that money to your parents, you send that money to your landlord, you send that money to whoever else is catering, is part of your expenses. Pay yourself first. That is what we call savings. So at the end of the day, you need to pinch a bit of this, a bit of that, cut where you can to ensure that you're able to still foot your black tax and still put money on the side. Because if you don't, it's a scenario of you're milking a cow but not feeding it. Finally, the cow dies. So you need to make sure that even as everybody else, including your landlord, your parents, and the whole community and everybody else, and your bank and your insurance company and everyone else is making money from you, you're also putting money on the side. You're not getting drained fully. There's money you're putting on the side. You're saving something for the future so that you know that your future is also secure. Because if your future is not secure, then it means as much as you're trying to help the community and help your parents, they will suffer a lot more when you're not there. So the thing is, you must make sure you sustain yourself.
Yes.
Pay yourself first, build your capital, let your capital earn something, it doesn't matter what it is and how much it is, but make sure there's money on the side to ensure that it's growing continuously. And as you grow in terms of how you're able to earn and the kind of income you're able to, then black tax becomes less of a burden. It's more of a burden when you're younger, but it becomes less of a burden because remember, these people actually don't take everything. There's a portion that they'll always take. It is not going to grow as fast as your income is growing. So at the very beginning, if you discipline yourself and teach yourself to actually put something on the side, then as your income grows, you find you put a lot more on the side and ensure that your future is actually safe and your parents and whoever else is in the community is actually able to be assisted a lot more, even as you grow as a person.
Okay, good. We've got one more question here from Stephanie. Stephanie's asking, what exactly are unit trusts? The concept has always been confusing to me. So they're asking for clarity, what exactly are unit trusts?
A unit trust, let me put it this way. We have heard of trust funds. And most times when we hear of trust funds, it's because we have children who have been left with a trust.
Yes. And
some people are managing it and you're making money. So it's a trust. It's basically an agreement or a fund, whichever you want to look at it, but it's a trust where you have certain people who ideally are the owners, we call them trustees, and you have certain people who are managing that trust fund. In this case, the reason why you call it a unit trust is because you own trust. So when you bring in your money, what you're actually doing is buying some units in this as trustees. This trust as you as the beneficiaries, the people buying the units, and has someone managing this trust on the side, who ideally would be a fund manager. So you have this fund that has a trustee that ensures, who is the owner of the funds, that ensures that the fund manager does what is required of them, ideally, and then you keep buying certain units and invest in this particular fund, and it keeps growing. So it's as simple as that. It's basically a trust. You're buying units in this particular trust. This trust has certain trustees who are looking out for you, for your benefit, and as fund managers who are making decisions on how these funds are being invested accordingly. Yeah. That's the simplest way to put it, ideally.
Okay, very insightful session. Thank you. You've talked to us about the fact that we must seek an expert. We've talked to us about the fact that we must pay ourselves first. Yes, we live in a society where we need to help those around us, but pay yourself first. I think that's a very important concept that you brought out there as well. But very importantly, we must seek expert advice. And any worthwhile investment actually takes time. So thank you so much, Mwenda, for this very insightful session. That's all the time we have for this edition of Money Mastery, where we teach you how to make your money work for you. To learn more about our products, please visit our website, that is ke.ncbagroup.com. Or better yet, call the numbers on your screen right now. We would love to hear from you. Please like, follow, and subscribe our social media handles on your screen. Till next time, my name is Daniel Makau. Thank you, and do take care.